Let me bring in Dhirendra Kumar, the CEO of Value Research. Dhirendra, thank you so much for joining us. Several close-ended hybrid funds being launched in the market, and they're debt-oriented, which basically means it's a mix of equity and debt, but mostly debt and very little equity. Right now, I'm going to go over the names. There's the ICICI Prudential Capital Protection, the Reliance Dual Advantage, Sundaram Hybrid, and Union KBC Capital Protection that are currently open in the market right now. Do you see any merit in these funds at all? Should we consider them?
Yes, these are useful funds for somebody who is uninitiated, never invested, and has to make a lump sum investment and is a conservative investor. So, because they invest not more than 30-35% into equity, the rest is in fixed income. The other advantage of this fund for the uninitiated is that they come for a defined term. When investors invest in an open-end fund, they are looking at the value every day. But when you invest in a fund with a defined term of 2 years, 3 years, 5 years, then you don't look before that. So in that sense, it provides a decent, initial experience. But for these funds are not good for somebody who wants to invest regularly, and because these are open and shut cases. Most of them are closed and you invest at a time, meant only for lump sum. So I would say that, and these funds certainly have, they potentially can deliver more return than a similar maturity fixed deposit. So in that sense, they could be a little more rewarding, and they could be useful for the uninitiated.
Well, Dhirendra, given the interest rate right now and where the cycle is, do you think investors should be considering debt hybrid funds?
Yes, I think so, because fixed income, though they are yielding very high return, but what you get from a fixed deposit is taxable. Even what you get from little enhanced return from the FMPs and short-term bond funds, they could be little better, but they are unable to beat the inflation. And also I feel that the level of the market is such, despite the market attaining an all-time high, that 3 to 5 year time frame, little allocation to equity might prove to be reasonably more rewarding than what is available from fixed income avenues.
All right, Dhirendra, thank you for answering our questions. Dhirendra Kumar, the CEO of Value Research.